Welcome everyone to today's session on financial modeling, financial projections. Shruti gave you a very brief introduction. My name is Vikrant. I run this company called Fund Enable. At Fund Enable, what we do is we actually started off as an investment bank supporting startups in raising rounds of capital. And slowly we started investing in startups. According to my understanding, there are four core pillars of running a venture. There is product, there is go-to-market, there is building a team, and fourth is capital. What we do at Fund Enable is essentially come in with a small check and then the ability to raise multiple rounds of capital thereon, right? So we would come in, invest a small amount, and then when it comes to the fourth pillar, which is capital, we will ensure that we will keep getting more and more capital for you, right? Examples of companies which we've worked with. This is one of our portfolio company, eMotorrad, which is a Pune-based electric cycle company. We came in when the company was looking to raise 1 crore rupees in their first round of funding. So we came in, and post that, we've raised multiple rounds of funding for them. First, we raised 24 crores from a US-based climate impact fund called Green Frontier Capital. Then we raised around 166 crores from a bunch of investors, the existing and new ones. And just during this year's IPL, we also announced a round by MS Dhoni. And, around that time, you would have seen a YouTube ad of MS Dhoni actually sitting on a cycle and singing a song that went really viral, right? So this is an perfect example of what I do at Fund Enable is identify great companies, invest, and then ensure that they keep on raising multiple rounds of funding per se. Another company is a Bangalore-based startup called Work India, which is essentially a hiring platform for blue and grey collar jobs. So what Naukri is for white collar, Work India does the same thing for security guards, delivery boys, field sales guys, telecallers, and so on and so forth, right? So we met them at an incubator in Mumbai and came in when they were looking to raise 1.5 crore rupees of seed round. Post that, I have personally been involved in this transaction. We've raised 5 rounds of funding for Work India. The last one was a $12 million round from a bunch of investors. What we also bring to the table is difficult to find names. All of you are connected to the 100Xs and the, Let's Ventures and the venture catalysts of the world. But the trick is that how do we go beyond and how do we raise, let's say, from Japanese hedge funds or from US-based climate impact funds or Middle Eastern funds, right? So, what I tell everyone in fundraising is that if a particular investor is seeing a lot of deal flow, it is actually making sense to actually not go to them and go to a different investor and try to find strategics, right? So we are very good with that, finding investors across Japan, across Europe, US, and now also Middle East. Another company is a company called Task Tracker, which is again a SaaS platform identified at an incubator at IIT Mandi. And then we've been working with them on raising multiple rounds of funding. And that's the way we work, right? And these were some of the companies. There are a bunch of companies. We also work with a lot of investor partners that we bring to the table and incubators, right? A lot of times startups have not yet raised or exhausted the amount of, the capital that you are getting from incubators, right? So the first step is you should really focus on getting 30, 40, 50 lakhs, up to 1 crore and a half from incubators. There are multiple startups, like one startup is a company called CaneBot, which has raised around 1.5 crores just through grants from incubators, etc. Right? That essentially takes us to a level where we are ready to raise money from VCs and larger investors per se. So coming to today's topic, right, which is on financial modeling per se or financial projections per se. Typically, when we will go and pitch to the investors, we would essentially say that, hey, we need money. And why do I require capital? I require capital because I'm improving my product. I require capital because I'm hiring people. I require capital because I want to spend on marketing or customer acquisition, right? So typically, when we go and talk to investors, why we need money is for product, talent, customer acquisition, and so on and so forth, right? And immediately the question comes is, okay, so how much money will you be making, right? What is the kind of revenue that you will be making in the coming years? What's the kind of cost structure that you have, right? Understanding of things like unit economics, contribution margins, CM1, CM2, right? These are typical jargons in the VC industry. So addressing questions related to the costs, the margins, etc. And ultimately addressing this question in terms of how much money do you need, right? And how do I calculate that? There is a way to calculate the fundraise amount. When we say that I require 2 crore rupees, how is it calculated? The whole math behind that, right? So these are the primary things that investors ask when we go to them for capital raising, right? And what we are going to do is basically creating a financial model or a projection sheet essentially addresses these questions. And what we try and do here is basically forecast revenue and forecast expenses, right? But we have to do it in a way that investors understand it. And this is essentially what we are going to do over the next 1.5 hours. We are going to build a financial model for your company. Obviously, nobody can predict future with 100% accuracy, right? Nobody can predict numbers with 100% accuracy. But we need to have certain validated assumptions in place, right? So the basis of forecast is what we call as validated assumptions. What are the assumptions behind the numbers that you are actually showcasing becomes very critical. And are those assumptions validated, or do they look bizarre, right? Do they look unrealistic? And this is again a very critical element of building a financial model per se. So the way we are going to do it is we are going to split the discussion into 3 parts. We will first start by calculating your revenue. Then we will start by calculating your expenses. And then we will come up, the outcome of it will be figuring out the fundraise amount, right? It will be thrown by the Excel, right? So we focus on calculating revenue, then calculating expenses, and then the fundraise amount. So let's deep dive into the first block, which is calculating revenue. And to calculate revenue, we have to first understand, how do we make money? What is your revenue model? Almost every one of you know answer to that. But there can be different revenue models, right? You can have a subscription-based revenue model. You can have an outright sale model if you are selling a product, right? Ads, premium, commission-based if you are a platform, analytics. There are various revenue models and ways to make money. Your startup can have actually a mix of 2 as well. So let's say I am making revenue through subscriptions, but I'm also making revenue through ads, or I'm making revenue through commissions, but I also have a subscription-based model in place, right? So it can be a mix of 2-3 models, but let's first identify that what is my revenue model. Product, very simple, outright sale. I'm going to just sell a product, but softwares, SaaS, etc. You have various models, or platforms, you have various models in place. So in your mind, first think through what is the revenue model that you have, right? The second question that we have to address is what we call as building the conversion funnel, right? And what's a conversion funnel? How do you acquire customers? What is the average ticket size? And how does the conversion funnel look like? Which means, how many people do you have to reach out to before you convert a few of them into your customers, right? What percentage becomes your customers per se? And these 3 questions become very important to address to actually then start working on our revenue, right? So what we are going to do is we are going to think through the revenue calculation for your particular business. And I'm going to give you one example, and you can apply that example on your particular business. So we'll learn the concept with one example, and then you can think about your business and we'll have a discussion, right? So let's say if you are selling something online, right? You are a B2C product company and you're selling a product online, right? So what happens? How does the business work? You are showing ads, and because of that, traffic is hitting your website, right? X number of people are actually coming and visiting your website. Out of those visits, a certain percentage is getting converted into buyers, right? So 10,000 people visit your website, 100 people got converted into buyers. And those 100 bought a basket worth 500 rupees, or the average ticket size was 1,000 rupees, right? Whatever it is. Let's say they buy a mix of 2-3 products, or they just buy one single product. That defines your basket size or average ticket size. So what is your revenue? The revenue is nothing but number of buyers into the average ticket size, right? So in 1 month, you got 10,000 people visiting your website, 100 of them converted into buyers. Everyone on an average bought something worth 100 rupees. So, my revenue was nothing but 100 buyers into 100 rupees, right? So what are we going to do is we are actually creating a equation, a formula out of your revenue model, right? Out of your conversion funnel. So when I use this to project, I am assuming a certain number of traffic that is hitting our website. I am assuming a certain percentage conversion that will determine the number of buyers. And I'm assuming the average ticket size, which is again dependent on what has been happening. So what are my growth levers? My growth levers are actually the percentage increase in traffic that I'm showing month on month, the percentage conversion, and average ticket size. The moment I change any of these, my revenue calculation completely changes. So let me take you through how it looks like on an Excel, right? And I'm going to share this Excel sheet with you at the end of the session so that you can actually customize it for yourself, right? So this entire formula, what we saw, or logic, I have now put it in the Excel form, right? So basically, I have a certain, traffic hitting my website. I have growth in traffic. I have percentage conversion, and that traffic multiplied by percentage conversion is giving me customers. Now I have certain percentage which keeps coming back to me, which is repeat, and that gives me the number of repeat customers. And finally, I've also found the average ticket size. So average ticket size, or whatever people are buying at, multiplied by the customers, is giving me the revenue, right? So I have done first this exercise for a period of 3 months, actually, that let me see how is it looking like for the past 3 months. So last month, 18,000 people visited my website. This was basically an 11% increase over the previous month, out of which 1,300 people bought my product, which means 7.1% was my conversion. How did I calculate that? 1305 divided by the total traffic gives me conversion, right? When I looked at the customer data, 27% of these 1,300 were repeat buyers, right? And on an average, people bought a product for 161 rupees. So my revenue was 1,300 multiplied by 161, which was 2.1 lakh, right? Now, as I start projecting, what I do is these green numbers, which are growth levers, is what we call. I just make certain assumptions on it, right? So for example, on the previous month, I am assuming a 13% growth in traffic. Okay. I am assuming a 6% conversion ratio, given that over the past 3 months, it has been hovering between 5 to 7%. I am assuming a 6% conversion, right? And I am assuming a ticket size of 200 rupees because I have launched a new product, or possibly I've increased the price. What is happening is my revenue is getting now calculated automatically. With these assumptions, I'm actually going to make 2.5 lakh rupees of revenue. Now, I have done this for a period of 18 months, right? Month on month, I've taken certain assumptions in terms of growth in traffic. I've taken certain assumptions in terms of percentage conversion and certain assumptions in terms of ticket size, and that's it. Everything is linked by formula, and I'm getting the results automatically. So with this logic, by month 18, I will be at a 16 lakh rupee revenue number, right? Always remember, build two things in your projections. One is efficiency, right? As you spend more and more money, you are actually increasing the conversions. You will launch more products, so ticket sizes will increase. So keep that in mind. Second is keep seasonality in mind, which means it won't be possible that on a month I keep growing 13%, right? Certain businesses would drop in certain months because they are off-season months, and then will pick up again during the season. So build that logic in your business and calculate projections, right? The idea is this logic you have to apply on your business in 3 steps. First is try and create a formula out of your revenue model. Second is identify growth levers. What in the formula, if I change, will impact my revenue, right? Which will be your assumptions. And third is think efficiency and think seasonality if it applies to your business. And with that, you will be able to create your projections sheet per se very easily. Notice one thing, I've used certain, basically color codes, right? So the yellow one, okay, the yellow code the yellow cells are actually assumptions, and the white cells are, basically there's a formula here. So when someone is reading the model, when someone is looking at it, they know that, when if I want to see the impact, I only change or touch the yellow cells and I don't touch the white cells, because there you have a formula in place, right? And I've also highlighted the growth levers to give people an understanding that when I change this, it will impact, increase or decrease my revenue, right? So I'm going to take a quick pause and see if you have any questions related to what we have discussed. What I want you to think through is, think about your business, think how you will do it for your particular business. Happy to, give you solutions right away on the call in terms of, this is how you should do, this is what you should do, before we move to the next segment, which is the cost. Yeah, Nitin, you have a question, please go ahead.
Yes, thank you. So Vikrant, what do we do for the B2B? Estimating traffic for B2C or D2C is, you can predict something. What about in B2B?
Yeah. So in B2B, what happens is you acquire customers predominantly in 2 ways, right? One way is something like a feet on street or meetings, physical meetings, physical sales teams, or leads that are generated through B2B lead platforms, right? Exactly same model can be replicated for B2B. Example, I assume that over a period of time, each of my sales person will be able to do 10 meetings in a month, and out of those 10 meetings, 1 get converted, and that 1 which gets converted for a certain project size or a ticket size, right? Number 1. Number 2 is a lot of B2B businesses work on telecalling. So when I spend certain amount, I get X number of leads. Now telecalling, every caller does 100 calls a day, out of which 50 get connected, out of which 20 are more than possibly 2 minutes, and 5 get converted into essentially, basically people buy something, right? So what you have to replicate the process of conversion, right? How are you actually converting it? Whether it is through sales team, whether it is through lead generation and then telecalling, whether it is through lead generation, telecalling, meetings, physical, and then conversions. Entire model can be created on Excel, right? And that is an example of how we have also modeled B2B businesses, because today it might be operating in a certain way. For example, today you might be the person who's calling, or because of your referrals, you are getting it. In a modeling exercise, you have to think, how are you going to actually, replicate this and scale it, right? So let's say today you have been able to do 15 meetings in a month. You have to assume basically less number of meetings and less number of conversion, because as you hire people, they are not going to be as effective as the founder pitching person, right? So it all starts with how does your conversion funnel look like, and then creating assumptions around conversion funnels first.
Right. And this, I'm assuming that the same will be for B2, B2C, right? I mean, the conversion will be we are predicting the conversion for B2, B2C.
Absolutely, right? See, the key is the way the business is operating. The Excel should replicate that, right? A lot of times what happens is the business operates in a certain way, but they've not been able to convert that into a formula in an Excel, right? It has to be exactly same. That's why in this, the starting point is traffic hitting my website. We start with that. I have not just assumed, number of customers, growth in customers into average ticket size. No. We've started with traffic, growth, and why? Because these numbers are going to then get linked to marketing sheets and other sheets, right? So it's all a link model per se.
Okay, thanks. Yeah. Thank you very
much. Great. I think Simran has a question.
Yeah. Hi, Vikrant. So I have multiple streams, similar to what you discussed earlier, where we do D2C, we do B2B. So it's basically hair care products that we deal with. So we sell it on retail, we sell it to distributors, we sell it to salons and marketplaces as well. So when you're pretty much all over the place, when you are doing assumptions, how do you do you find a middle ground with all of this?
No. So what you do is you will have 3 tables.
Okay.
One will be purely for your own website per se. Okay. Right. Second would be for all the marketplaces per se, right? Okay. And third would be for B2B per se, right? So, and then the final revenue would be A plus B plus C. So you will essentially have 3 tables, one below the other, and then ultimately revenue will get calculated, because each of the stream will operate in a very different way. Your salon's business possibly would be through, feet on street model, whereas your D2C will be purely through digital ads, whereas marketplaces would be driven through something else, right? So you will have to create, basically different revenue tables, and each will have a different assumption the way it is working in your business.
Got it. All right. Thank you.
Perfect. Yes.
Hi, Vikrant. I have a question here.
Yeah.
So I'm Sachin from iPanel Clean. So we are into solar and solar plants cleaning system technology, which is disruptive and patented that we have. So we are the only technology of its kind in the world. So that's what we are currently working on. And how we have done our projection is that we have estimated very, very basic level of targets for us, because even one customer can fulfill our full year target, or it may not be the one customer. We may have multiple customers. So it is difficult to predict the number of customers that way, but it is easier for us to give a quantity of the solar plants that we can do in the first year, or in the second year, or in the third year. So that is the way we have done our projection. Would you have any comments on that?
That's okay. Yeah, that's
sure,
fine.
Sure.
Try to from a business standpoint also, try to kind of figure out things like, let's say if you want to convert one of those, and it will happen over a period of time, but how many, prospects do you need to have for that, right? Typically, because the money that you will spend, when I'll come to marketing, okay, the money that you will have to spend will be on the prospects, right? So many meetings will have to be done. While in your case, possibly marketing from a spends perspective will not be there. It would be more of sales effort than marketing effort per se, right? But over a period of time, you can try that. But see, every business has its own ways of operations, right? And you have to model it as per your particular, the way your business operates. So that's perfectly okay.
Right.
Yeah.
Okay, great.
I think Pulak has a question. Yeah.
Okay, sure. Thank you.
Yeah. Pulak, you can unmute yourself and speak.
Sorry, am I audible now?
Yes.
Yeah, so like we are into a very early stage, and last 3 months is the first time that we have had generated any revenue. And we have, as of now, we are doing a pilot with 4 customers, and we have had a 100% conversion rate so far. So in such a case, when you are very early, how do you project revenue, and how do we start with building a sales funnel, or what you just mentioned? How do we start generating that funnel? Because we are very early on in our journey, and also we are not able to assume how many customers we'll be able to acquire in the next 3 months. With whatever leads we are getting, we have been able to convert them so far. And we are building a manufacturing analytics platform. We have kind of a niche in what we are providing. It's relatively early in India for the solution that we are providing, but still, how do we go on building a revenue projection for such kind of scenario?
Sure. So, see, at a very early stage or an ideation stage, if we are building projections, there are 2 things that I usually recommend, right? One is, talk to other companies, other founders, may not be exactly in the same business, but where your type of sales funnel is used, or your type of customer profile is there, and check, right? One of the big values that cohorts and programs bring is this understanding from other founders that, boss, what is your cost, or how much did you hire the sales guy for, or what was your process? In your case, it is all about, what should I assume? Is this assumption right? Whether I'm making a very, optimistic assumption per se. So that is one where you benchmark basis similar business models, similar companies by talking, because data will not be available. So it's just by talking to other founders. Second is, this is where also mentors come into picture, where assumptions from them, validation of assumptions from them plays a very critical role, right? So example, if you come to me and say that, hey, you know what, I am at an idea stage, I'm looking to raise 15 crore rupees of capital, right? I'm immediately going to tell you that, what you should be doing, you should be looking at 2 crores, because at basis my experience, at a pre-revenue ideation stage, founders very rarely have been able to raise upwards of $2 million, right? So this is an input that I'm giving. Similarly, on that particular vertical, you will have to get inputs from mentors and get those validations tested so that they don't look absurd, right? And that's what you will have to do. At the end of the day, third thing is, it is going to be a complete, tukka in a way that you will not be able to get it right. What people also do is do small pilots. Example, if I am acquiring B2B customers through third-party platforms like Just Dial, or B2C customers through Instagram. So what I'll do is, I'll actually run a very small campaign by spending 3,000-4,000 bucks or 5,000 bucks. That will give me insights into how did it work? What was my cost? How many leads did I get? How many did I convert? Right? So a lot of times, very small scale pilots can give you a basis for assumptions which you can defend, right? So if the investors ask, oh, how are you saying that your CAC was this much? You would end up saying that I've done marketing campaigns at small level, and this was the outcome, and this is what I was doing, right? So this is how you will be able to essentially put things together.
Okay. Thank you very much.
Iftikhar, I'm going to take your question, which is going to be the last before we move to the next section.
Sure. Yeah. Hi. So we're actually in the business of setting up EV charging infrastructure. It's a fairly new field with a lot of unknowns and uncertainties. So we've drawn out our projections based on certain assumptions on And again, this is me just brainstorming with you and trying to get your feedback on, does it make sense what we're doing? So we have taken a look into we've looked into some numbers of the sales growth of EVs in India, and in different segments of that, and also we put some assumptions as to how much traffic we'll be able to attract into our charging infrastructure, so on and so forth. But I think the biggest challenge I think for us is it's a chicken and an egg problem, because we know that the adoption is going to happen. We know that the EVs are going to exponentially increase on our streets and adoptions and all that. So when we go to investors and all, I think the conversation is about. So I'm of the opinion that let us start putting charging stations as and where we are able to, because traffic to aana hai, traffic ko, so on and so forth. But then is that the language? I just want to check my language and say, is that the right thing to even tell investors, or make the investor understand that it's a chicken and an egg problem. So for example, in the parallel of telecom industry, if you don't put up the your transmission towers, you'll not be able to scale up your network. It's very similar to that. So you need to do your capex spending and all that on your transmission towers. Jahan pe aap laga sakte ho, laga do. And before that's how your network will grow. So what are your thoughts in terms of is this the right strategy, or do you think there should be a different way to look at it?
Sure. I'm going to very quickly address this. So basically, see, and this is what I tell every founder, okay? Always remember, banks fund your balance sheets and VCs fund your P&Ls, okay? Go to a venture capital investor and tell them that, oh, you know what, I want to set up a factory, I want to set up a plant, I want to set up infrastructure. That's not their primary job. They will never give money to set up hard assets. Go to a bank and tell them that I want to spend 1 crore rupee on digital marketing. Okay, the manager will fall off his chair. What are you really? You want 1 crore rupees from me to spend on Facebook, right? So understand the primary difference between the overall sources of capital, right? Why is it that electric vehicle startups, charging infrastructure startups, solar startups have not been able to raise a lot of money? Is because VCs predominantly don't come in and invest in hard infrastructure. You ask money for customer acquisition, manpower, technology development, all of that, you will get money, right? Because banks fund balance sheets, VCs fund P&Ls, right? And therefore, you should definitely, anyone who's actually asking money for infrastructure rollout, and lot of money, right? Like in this case, 5, 10, 15 crores is not going to be enough. It's going to require hundreds of crores. Strategic investors are the right way to go versus financial investors, right? Strategic investors are larger players willing to get into this, basically looking at forming JVs, essentially over a period of time, acquiring you full out, right? But if you go to VCs and say that, hey, I want to raise 15 crores, then 20 crores, then 40 crores in hard infrastructure, you will always have a difficult conversation. And they will say that, your business is not scalable as per us. While it's a great business opportunity, you have to talk to different set of investors. Today, obviously, that's not the topic where I teach how to reach out to investors and which investors to reach out to. But you should look at strategics who want to get into this game and raise money from them, rather than going and talking to VCs, because they will understand this business really well, right? So happy to have later, a detailed discussion around this per se. 90% of startups face the challenge of knocking the wrong door. We are actually not going to the right investor, and then we think that, you know what, when I was raising my first round of capital back in 2014, I faced the same challenge that, I was going to people who were actually not right for me, right? And if we only tweak that, we'll actually be able to raise a round of capital first. Great. So
yeah, thanks, Vikram. Would love to connect with you later on. Thank you.
Sure. So now, after revenue and think through your revenue calculation, build your revenue sheets. After thinking through the revenue calculation, I want to go to the cost calculation, right? And again, I'm going to go back to the Excel sheet and let's look at what costs are there and what are the major costs and how do we start projecting, right? So you can see my Excel. Yeah, perfect. So the first cost that I'm going to actually focus on is basically the manpower cost. Okay. So what I've done in manpower cost or projecting manpower cost is, as step one, I have built an organizational structure of how my organization will look like, not today, but maybe 2 years down the line. What are the various job roles or what are the various positions that should be there in my organization, right? Again, this comes by talking to other founders who are scaled or by talking to mentors and your own understanding. A lot of times we don't realize that, we need these kind of people 2 years down the line. That only comes through after we speak with people who have scaled businesses or mentors who have supported scaled businesses and our own logic, right? So the first thing that I've done is that what will I need, right? So I'll need basically a CMO, a CTO, I'll need a few people in technology, I'll need a few people in marketing, what roles, what levels for this particular business, right? So I've just listed down those heads, right? Now I have mapped it against where I'm at today, right? So for example, today I am acting as the CEO of the company. My co-founder is the CTO. I have one senior developer, one developer, and one UX associate. I have a couple of people in marketing, and that's it. Today, I'm a 7-member team, right? That is how my org structure or chart is looking today. Now, what I do is, depending on my revenue scale-up plan, I start hiring people, right? So, I want to now put together a core team and I want a chief marketing officer. So first thing I'm going to do is I'm going to hire a CM. I'm good at the technology level. I don't want any people, but on marketing front, I want to actually have, one more, I want to hire more people. On operations front, and you know what, I did not have an accounts team in-house, so I'm going to hire people for accounts. And this, I ramp up slowly for a period of 18 months, right? So some of the team members I keep flat. Obviously, you will have one CMO, one CTO, one CX CEO, but senior developers, I'm adding, UI, UX guys, creative head, campaign heads, operations, I'm adding, and over a period of time, at the end of month 18, I am at a 37-member team, right? So I've already reached 37-member team in month 14, and then I've kept it stable, right? So the first table is all about the roles and the revenue ramp up per se. That's it, right? I'm not going to do anything else. So this is the first table that I'm going to make. Now I'm going to copy paste this. Okay, I'm going to copy paste this below, and now I'm going to assume their per month salaries. So as CXO level people, we are going to take 1 lakh rupees per month. That is what, at least during first round of funding, I've seen people taking 1 lakh rupees per month. Then you assume a certain salary for your tech guys, your marketing guys, and you assume an increase after 1 year, right? Now, where do I get this data? Again, by talking to people, or platforms like Naukri, etc., give you a salary meter. That today, if I'm hiring someone for content development, at what salary would they come in your city? There are a lot of these salary meters which are provided. So basis that, I have assumed per level, what is the per month salary, right? That's my second table. And now I copy this table again. But right now, instead of inputs, this table is just a multiplication of table 1 and table 2, right? So I have one CEO, obviously, that CEO is making 1 lakh rupees per month. So the total salary of CEO for this month is 1 lakh, right? But possibly, I have maybe three content people, and I've assumed a certain number, so that calculation is automatically happening. Okay, 75,000 multiplied by 2, right? So 1,50,000, that calculation is happening automatically over here. So this the third table is only A multiplied by B. And with that, when I sum the numbers in the third table, I am getting a monthly salary bill, right? So by the end of 18th month, my total monthly salary outflow will be somewhere around 25 lakh rupees, right? So it started with around 5.5 lakh rupees, and my total salary bill will be somewhere around 25 lakh rupees. And that is how I have ramped up my team or on the personal front, right? So again, same logic: yellow cells, assumptions, white cells, formula, tables, 2 tables, third table just a multiplication of 2, and that captures my basically the personnel costs or the manpower cost. I'm going to take a quick pause and see if you have any thoughts, any questions on the manpower cost calculation per se. Any ideas, any thoughts? Anyone? Pretty straightforward. And obviously, I'm going to share this template with you, and you will be able to kind of, do it yourself per se, right? The next, I'm going to.
Sorry, I just have one question. So, in the manpower cost, so would you, the stock option or shares option that we give to our co-founding team or the core team, would you consider that as part of the cost of the manpower, or how do you calculate it?
So overall, at the company level, yes, that is the ultimate thing. But this is more of a cash out, right? That what you are paying in cash to them. And ESOPs is more of a balance sheet item, or it's more of a part of the shareholding, right? I also have created an ESOP calculator, which I'll share with you, right? So how do I determine how much ESOP should I give to people, right? What is the basis of that? And how do I present it to my core people that I'm hiring, that, oh, you know what, you will get this much ESOP going forward, and that will be the value of your stock, right? So I'll share the ESOP calculator also. But that doesn't get, I would say it's not a part of this particular calculation. This is predominantly only the cash that you are offering to the employees. Yeah.
Thank you.
Perfect. So moving on to the next cost, which is again very critical, and we will deep dive into this both in terms of B2B, B2C. Let me explain basic how every business looks at cost of marketing per se. So today, most of us, right, 90% of whether B2B, B2C, we are essentially generating leads and conversions through online platforms, right? Online channels like Google, Meta, whether it is Just Dial. So we are essentially spending on platforms, and those platforms are either driving revenues or generating leads for us, right? And that is where one metric becomes very important, which is called CAC, okay? Cost of acquiring a customer digitally. Now, what is a CAC? CAC is basically how much money I spent on marketing and how many customers I acquired. Basically a division of total marketing spends by number of customers that I have acquired. So let's say last month, I spent around 1 lakh rupees on digital channels, right? So 1 lakh rupee and I acquired 1300 customers, right? So my CAC was 1 lakh divided by 1300, which is coming out to roughly 77 rupees. So every customer was acquired at 77 rupees. This is not cost of lead. This is cost of customer acquisition, which means cost of conversion. So you might have gotten, like in 1 lakh rupees, you would have received possibly 10,000 leads, but only 1300 got converted, and therefore your CAC is 1 lakh divided by 1305, which is coming out to 77. And this is a very critical number to calculate your digital expenses, or predominantly 90% of your marketing expenses per se. How do we do that? It's very simple, right? In the same, I'm going to take you to the other sheet now, which is marketing sheet, right? So the same example, total customers, okay, last month were 1305, and I had spent 1 lakh rupees to acquire, so I had 77 rupees of CAC. What I've done now is I've simply started assuming a certain CAC number basis the historical, right? So my CAC has been ranging between 75 to 104. So I've assumed 85 for the first 3 months, and slowly I've increased the CAC, right? The total marketing spend is calculated by taking this number, total customer number, from my revenue sheet. So we have already calculated the total customers in the revenue sheet, which was 1247. So what I've done is I've pulled this number from the revenue sheet into the marketing sheet, and just by multiplying it with 85, which is the CAC assumption, I am getting the amount of money that I need to spend on digital channels to acquire those 1247 customers, right? Very simple. So this is like a 2-minute job to calculate the digital spends. Customers I've already calculated. I've made certain assumptions on CAC, and my marketing spends are getting calculated, right? Always remember, your CAC over a period of time does not go down. In fact, it goes up. Why? Because as more funding comes into your sector, more and more startups start spending digitally. More and more startups basically are chasing the same set of customers, and therefore the cost of acquiring customers increases. So every time you will notice that you are spending digitally, but some startup in your sector has actually raised a small round of funding. In the next 2 months, what you will immediately see is your CAC has suddenly increased. Why? Because the same set of customers, basically someone is targeting the same set of customers, and there are multiple players now who are reaching to the same set of customers, and therefore the cost of acquiring customer is actually increasing. So as you go deeper and deeper, CAC increases, and that is where the influence of brand has to come into picture. Initially, you have to spend digitally to acquire customers. Later, your organic should drive the business, because otherwise the CAC would be very, very high. Why most startups have failed is because they've not been able to establish a brand or customer affinity. And because of that, the moment they stop spending on digital channels, their revenue drops. It drops immediately, right? So you have to reach a stage where even after some years, when you taper your digital spends, your revenue should stabilize or continue to increase, because organically you should get repeat customers, more customers, word of mouth, all of that should essentially kick in, right? So do not predict a rapid fall in CAC. In fact, as you scale, your CAC can grow up. It can go up, right? On top of that, I am actually now assuming a certain random number for PR, other initiatives like, hey, I'm going to, be a part of maybe some exhibitions which happen in my sector globally. So all of these are budgets, right? So I'll assign a 50,000 rupee PR budget. I'll assign a overall 10 lakh rupee budget for exhibitions. And together, then you will be able to calculate your total marketing spends, which is nothing but digital plus PR plus other initiatives. and that takes you to your total marketing spends. This continues for a period of 18 months, and you have a month-on-month total marketing spend sheet which is available, right? And that is how we calculate it. I'm going to take a pause here, and I want you to think through how you will do it for your business, right? How will you assign? The key in financial modeling is whatever process which we are running, it is a very hard exercise, but it is possible. You have to convert it into a formula, right? Imagine your marketing function is basically a formula. Your revenue function is basically a formula, right? And then within that, you have growth levers. So for example, in marketing, what is the lever? It's the CAC. The moment you change that, your entire thing changes per se, right? So these are variables, right? This is precisely why we learned equations in school, right? To identify what variables, when I change, the impact on the final answer, there is an impact on the final answer, which is in our case, marketing, revenue, manpower, and so on and so forth, right? So quick pause to see if there are any questions related to what we have discussed so far. Any thoughts, any questions, any ideas, anything that you want to discuss related to your business, and think through how revenue, sales, all of that will work. Happy to address that. Any thoughts?
One of the things that we have realized in the market is that as we acquire, so in the EV charging space, obviously, as we acquire big brand customers like major hotel groups and all that, and as the word of mouth spreads, at that point our acquisition model converts from pushing to pulling. So instead of pushing the concepts and all that, we get pulled into conversations. So we've definitely seen that as a sort of network effect or a marketing effect. So I just wanted to mention that to you.
Yeah, perfect. There's a question from Sanjay. Okay, how much marketing cost should be assigned to driving that revenue growth, even in B2B2C segment? I think this is it's a question related to the revenue which I'm seeing right now. So Sanjay, I hope I have addressed that answer through the marketing sheet, that to drive that revenue now, because I have essentially the customers that I've pulled in from the revenue sheet itself, that is linked, and therefore I know exactly how much money I need to spend to acquire those number of customers per se, right? Great. Anyone else? Any thoughts? What I want to also showcase to you is it's also a bit of Excel work, right? So column O in all my sheets will actually have month 9 of estimated period, right? So let's go to this, right? In revenue, column O will have month 9, right? In manpower, column O will have month 9, right? So it's very standardized. So you can pull numbers from different sheets, and you are able to still, you will not make errors when you do this, when you build the Excel, and you don't need any special knowledge of Excel. It's just basic hygiene while using Excel that we've been able to build this model per se, right? Moving on to the last one, and you can keep adding different segments of cost. The whole idea is everything will have a different sheet. So revenue has a different sheet, marketing has a different sheet, manpower has a different sheet, and now every business will have certain expenses, right, which have clubbed in tech and others. For example, you will have maybe AWS expenses, SMS and email expenses, some technology related expenses, right? Rent. So the way I assume rent is I simply multiply a per seat rate with the head count, and I get the estimated rental, right? Same for laptops, right? I assume that we are going to hire laptops, or we are going to get laptops on rent. multiply it with number of people, and I get laptop rent cost. Travel cost again can be assumed that certain set of people will travel. Per travel will be this much, and they will travel 3 times a year or whatever, and those costs can be incorporated. So all these small costs can now be calculated. The key here is to not miss out on anything which is material. Okay, small costs, if you miss out, it is okay. But the key is to not miss out on anything which is material, right? Which means that it shouldn't be a large part of your overall spends per se, which you should be missing, right? So just by giving you these examples, I'm just showing you how you can actually, keep building your different costs per se, like marketing, like personnel, right? In terms of manpower, how we have kind of ramped up people, how we have assumed realistic salaries, and how we have assumed tech and other costs related to servers, emails, SMS, laptop, and so on and so forth, right? The final is to bring all of this on a single sheet, right? So now we have revenue, we also have different costs. I'm going to bring all of these on a single sheet, which I call as the P&L, right? So from the revenue sheet, I have brought these. You see, this is actually taken from revenue sheet, right? This is taken from marketing sheet. This is taken from manpower sheet. So all the final answers, right? All the bottom lines, I have kind of pulled it from those individual sheets, brought onto these sheets, and build a P&L. Revenue minus all the costs, right? The total cost is what is giving me a number called EBITDA, right? Which is earnings before interest, tax, depreciation, and amortization. This is a very critical number, which is more likely our profits, right? Our operating profits. The technical term which is used here is EBITDA, right? And this revenue minus all the costs, I have done it for a period of 18 months. Revenue minus costs. Now notice here, all the numbers are actually coming negative. These are all in red. They are all negative. Why are they negative? The reason why my EBITDA is negative is because I am in the growth stage. It is not because my business is not doing well. Try and understand that. It is not because that revenue is not getting generated. It is because constantly I am scaling. Constantly I'm growing. I'm in the phase where I'm hiring people, I'm growing, I'm spending on marketing. And because of that, I have a burn. And your fundraise amount for a one round is nothing but, this is very critical, is nothing but the sum of your negative numbers for a period of 12 to 18 months. So when I sum these negative numbers, what I get is actually the amount of capital that I need to execute my plan so that I can scale. I am temporarily negative because I am scaling. And the sum of negative EBITDAs is actually, this number is coming out to minus 3.6 crores, which means my funding requirement is actually 3.5 crores, right? Otherwise, why would you need money, right? Otherwise, why do you need a round of capital, right? You need a round of capital because you are having a burn for a period of 12 to 18 months. The burn is not because your business is not doing well. The burn is not because you have not been able to make money. The burn is because you are growing, and that growth is getting reflected on your P&L, and therefore there is a burn. And the sum of that burn for 12 to 18 months is actually the amount of capital that you need. Now, if this number comes out to 15 crores, what you need to do is you need to scale down your plans to make it at 2, 3, 4, 5 crores, whatever, depending on the stage at which you are, right? A lot of startups come to us and they show their projections. And in the first year itself, they are positive. And they say that I'm looking to raise 4 crore rupees for marketing, manpower, technology development. The question is, you are positive right away, which means you have enough revenue to take care of your costs, then why do you need a round of capital, right? Then you don't need this 4 crores as per your projections. The reason why I need it is because for this period, I'm actually going to burn because I'm scaling up, and that is how we calculate the fundraise amount. So don't take me wrong. Don't take me wrong that I'm not teaching you that, hey, if you want to raise a round of capital, you need to be loss making, right? That's not what I'm trying to tell you, right? Mathematically, if you don't showcase a burn in your projected number for a period of 12 to 18 months, you won't be able to justify the fundraise, right? And that is exactly why you need to raise a round of capital to actually plug in your negative EBITDAs per se. And your financial model now becomes ready with your fundraise amount, right? On top of this, you assume certain amount for what we call as working capital, which I'm not going to touch upon today, but let's say 10 to 15% on top of this, you can actually keep for working capital, right? Notice all of these are expenses, right? Employee, manpower, marketing. This is not the money that you are taking for setting up a factory, setting up, a plant equipment, buying land for your factory and so on and so forth. That amount will not come through from venture capital investors. For that amount, there are 3 options. You will have to put in your own money. You will have to figure out a way to work with banks. You will have to get a strategic investor, right? And that is how our financial model, basically is built in a very, very, I would say, quick and easy way. Right? So what I'm going to do right now is I'm going to actually share this Excel sheet with you on your chat window, and you will be able to then essentially access that Excel sheet. Let me actually push it on your chat window over here. You can download it and you can start using it. You can customize it and start using it, right? Obviously not a part of this particular session, but because there was a question, I am also going to share the ESOP calculator with you. ESOP scenario analysis. So both these sheets are now available on your chat window. The template can be used to essentially look at customizing your own business basically as per your own business, and you can use that, right? So what we have actually seen is basic definitions, essential terms, and the structure of financial model. Why is financial model actually required? How did we go about, or how do we go about creating financial models step by step by using the template and understanding essentially revenue, cost, fundraise amount, and so on and so forth, right? Happy to address any questions related to the topic, related to the costs, revenue, whatever, or overall the negative EBITDA concept. Please feel free to ask questions. Yes, Nitin, you have a question. Please go ahead.
Yeah. So Vikrant, I missed it, but I'm just going to ask it again. Where do we basically accommodate or allocate funding that we have already received, or bootstrapping that we have done from our side?
Yeah.
That is not seen in the model somewhere.
Yeah. So see, what we have seen is the projection part, right?
Yeah.
The impact, the status that you are today is essentially the reason behind that is what you have put in, right? So when you will build balance sheet, your current balance sheet will reflect that, right? But your future will not have that, because you're assuming this as a post-funding model, which means that when in month 1, I'm raising money and this is the outcome. What you're showcasing is actually a post-funding model, and not the historicals per se, right? So the money that you have put in has now become a part of your historical statements, right? What we are building is projections.
But then why is what I have done business becomes important in the projections.
It does, because that is the base from which you will start, right? And that will impact everything. That will impact your revenue. That will impact your valuation eventually, because you are not starting from zero, right? The fact that you've invested, the assumptions only start at a certain level, right? Because product development has happened, all of that has happened, and assumptions start from a certain level, right? And therefore it automatically gets captured in a way.
Right.
Yeah.
Just one more thing. Is there a way to accommodate the cost of a patent into this or IP into this?
The cost or the value.
I mean, see, for now, let's take at least value. Assume that, just take value.
Yeah. So see, value will be attributed to valuation, which is another topic, right? This is purely projections, right? This is purely revenue and cost. When you sit on the table with the investor to talk about valuation, and obviously there is a full topic, 1.5 hours of valuation session which we'll have to do. But the overall, when you talk about valuation, that is when you bring out these points and attribute a value, right? That, oh, I have patent, therefore I need to get additional value of 20% over what you are essentially putting out, right? That discussion will not be a part of your projections. The way it will be is that because it's a patented technology, maybe you might get higher revenue or something, right? But talking about patent, I want to also highlight one thing is that there are only 3 areas or sectors where I have seen patents actually translating into valuation or translating into business, right? One is defense tech, second is space tech, and third is pharma/health tech, right? Apart from these sectors, patent gets valued after revenue. In these 3 sectors, patent gets valued before revenue, right? That in pharma today, if you have a patent, or in defense tech, investors are willing to give you a valuation just because you have a patent. In others, it is a good to have thing that, ultimately I'm going to value you on the basis of the revenue, right? So, I'll give you an example. There is some app or process that a tech company has patented. It's not going to give any value, because ultimately a revenue will drive the value, right? A small tweak here and there, a small change, it is doing a job of protecting, but it's not, because of that, you are not creating a very, very big entry barrier, which is actually driving revenue per se, right? So you should look at it from this angle and think about that element, right?
I have a question that we've been into business from past 3 years, right? And we've been EBITDA positive and overall profitable throughout, right? But now, because since 3 years we've been bootstrapped and we've been growing slowly and steadily. But now we want to bring in a lot of, we have a D2C brand, right? And now we want to bring in a lot of products so that we can cater to a wider audience, a larger audience, and disrupt the market. So my question here is that in order to grow and scale aggressively, we want to raise funds. So can we give this reason to the investor that this is the reason that we are going for fundraising, because we have this, although we have been profitable so far.
Yeah, this is exactly the reason why you need to raise a round of capital. It's great that you're profitable. On a unit level, you've been able to showcase that this business can be profitable. And now you need money for scale up. And scale up means marketing, hiring more people, building a better product per se, launching more products. And that is exactly why you need to raise a round of capital, right? So this is precisely the reason why you would get money.
Perfect. And another thing I wanted to ask, so how do we calculate the value of our company? Because so would that be, is there any template that wherein we value our company which is directly proportional to the total revenue that we made?
Yeah. So again, this is a 1.5 hour session on valuation and deal structuring. I won't be able to explain it in a minute. We go through basically a couple of valuation techniques which are very easy. Basis which we value startups and then calculate dilution, etc. But I will leave that and come back on that through maybe another session or through a video, right, for all of you.
Okay. Thank you.
Perfect.
Thank you, Vikrant.
I think we have two last questions, final ones, one from Chandan and one from Simran, and then we will close it.
Hey, hi, Vikrant.
Hey,
Can I ask this question? Or Vikrant,
Please.
is it okay?
please go ahead.
Hi. Okay. So, Vikrant, we already have prepared our 5-year plan. It is on the same line as you suggested. Just wanted to get your understanding and your opinion. In case, is it okay to share it with you or your team, and then get a just a suggestion so that we are on the same line?
Sure. So get in touch with, I think Shruti, you are, you can get in touch with Shruti, and then we can try and coordinate this.
Perfect. Makes sense.
Great.
Thank you.
Yes. Simran?
Yeah, hi. So we have been a bootstrap company since past 2 years. So I started the brand in 2019 and built a community before launching the product. So I knew exactly what the consumer needed, especially with the haircare products. And 22 is when we launched. I've done everything by myself. So now, my question being that there are two ways to go around raising funds. A is project finance debt or equity. Since we are at an ARR of 10 lakhs monthly, I'm just concerned that will we get the right valuation that the company deserves, or should I take debt, increase it from 10 to 50 because the company has that kind of potential? So should I raise it from 10 to 50 with the debt, pay off the debt, and then get dilute my equity, or should I start with it from now?
Sure. So see, and this is again an answer to all of you, right? That a lot of times, simple working capital facilities from banks can help you scale up, especially if you are making revenue, if you are profitable. Like in your case, Simran, that 10 lakh rupees of monthly revenue is there. You're fairly profitable per se, right? A simple working capital facility from bank can drive your revenue from the current level to whatever level it can take, right? Let's say you get a 20 lakh rupee working capital facility. You are able to, put that and get to a certain level, right? And in working capital or CC limit, it's not that you've taken a term loan, right? That you've drawn down the entire amount. You can start with simply 5 lakh rupees in digital, additional 5 lakhs in digital, and that can actually give you crazy, returns, right? So, as far as possible, the more you differ in terms of raising a round, obviously the valuation would be higher, right? Because your revenue and your numbers would be better, right?
Yeah.
However, a lot of times you also get investors for their connections, network.
Yeah.
So that can come in early. Second thing is, it's also about, again, I'm saying it's also about timing, right? So, for example, any even differentiated hair care product for specifically curly hair per se, today from a timing standpoint, if you delay it, there are brands that are launching, larger players coming and launching. Then even at a 50 lakh rupee monthly revenue number, people are going to ask, how are you different from so much which is happening in the market, and will you be able to scale, right? So it's actually a decision between these two things, right? And therefore give it a try at capital raising in any case, and working capital facility right away, right? So get the working capital facility right away, start pumping that, and start talking to investors, because the investment conversations are not going to close in 15 days or a month, right? It's going to take at least 3 months. In that time period, you've already started using the working capital facility, and you've taken your company to a higher revenue number, right? So that is what you should be doing.
And would the investors be comfortable if there's a bank loan that's already on the company?
Absolutely, right? It's a very debt is cheaper than equity from a cost of capital standpoint. So if your business is eligible for getting whatever loan, right? If you're, the problem with startups is that they don't get it, right? But if you are in a position where you can get, you're actually taking a very good financial decision by opting for a lower cost financing, right? Which is over equity. So it's always, something which you should look at.
Got it. Yeah. Thank you.
Great.
If you're okay, I'll just send you the pitch once on LinkedIn.
Great. So that's it from my side. Thank you so much. Thanks a lot for patiently listening to me for 1.5 hours, and hope to see you soon. Thank you, Shruti, for giving me an opportunity to talk to the cohort. Thanks a lot.
Always a
Thank
pleasure.
you very much.
Thank you, everyone.
Great session. Thank you.